안녕하세요. 김현석의 월신나우의 김현석 특파원입니다. 반갑습니다. 요즘 투자자들 여러분들의 고민이 많으시죠? 미국 중앙은행의 강력한 긴축이 예상되고 있고 거기에 우크라이나 사태까지 불거지면서 불확실성이 굉장히 큰 상황입니다. 여러분들의 궁금증도 많으실 텐데요. 그 궁금한 점들을 제가 네드데이비스리서치의 클리솔트 미국 주식 전략가를 만나서 물어봤습니다. 지난 12월에도 인터뷰를 했었고요. 이번이 두 번째 인터뷰인데 그 내용을 들어보시면 여러분들의 의문이 조금 풀리지 않을까 합니다. 자, 시작합니다. First questions. I would like to ask questions about the Ukraine crisis first. How do you think the situation in Ukraine will develop? And is the President Putin looking for a deal than war, you think?
Well, I think only Putin knows what Putin wants to do, and so there's several ways that this could go. But from a geopolitical standpoint, there certainly are incentives on both sides to find a peaceful solution that would allow for energy supplies to continue to flow from Russia to the rest of Europe, and the economies in Europe to remain on a positive trajectory.
Mm-hmm. Did you find some kind of a hopeful sign today, or it's not just you don't think it's not hopeful?
Well, I think it's too soon to say. Certainly, if moving troops off of the front lines is probably a positive sign more than a negative sign. Whether that's just posturing, we'll have to see how it unfolds from here.
If Russia starts to attack the Ukraine, how do you expect the market to react? How do you think it will affect the U.S. and global economy?
Well, we've looked at studies going back several decades at various crisis events. They're geopolitical events, but also market financial crisis types of events. And there's a very consistent pattern that the uncertainty over the event leading up to it and then the immediate aftermath both tend to be negative. But once the markets start to understand what the risks are and what the path is moving forward, they tend to recover. So on average, the Dow Jones Industrial Average, can lose up to 7% around the crisis itself, but within 6 months, it usually recovers those losses. So that's the average. I think in this case, there's a very specific risk when it comes to global energy markets, which are already very tight from underinvestment and supply chain issues and economies coming back online from the pandemic. So that could be an additional risk that could push energy prices higher still, which would be obviously a big problem from some sectors of the global economy.
And also the inflation in the United States. It will stimulate more hike or more inflation in the United States?
Well, I think the U.S. is, it will be impacted like anybody else because most commodities are global in nature. The one that is probably the less global than many others is natural gas, just because the transportation is so difficult. You have to liquefy the natural gas, get very cold temperatures and then transport it. And the United States is trying to export as much liquefied natural gas as it can to Europe, but it's just not going to be enough. And in fact, there's a glut of natural gas in the U.S. by some measures still. So I think the U.S. would probably be a little bit better shape, but overall, yes, commodity prices would be higher. That would lead to higher inflation, and that would complicate the Federal Reserve's positioning, and on balance would probably lead them to hike a little bit more aggressively than they would otherwise. Now, the other side of that is if it does lead to a sharp global slowdown, that is, there's a demand slowdown, then the Federal Reserve may have to balance those two factors out and reason that any spike in commodity prices would be shorter term and not part of a sustainable inflation problem.
And oil price rebounded again to 90s. And how do you see the crude oil markets? What if the Ukraine crisis is resolved and the Iran nuclear deal is reached?
Yeah, so those are both, be negative for crude oil and positive for the global economy as a result of lower prices. But the bigger problem has been over the past, 6-7 years, investment in traditional energy has been much less than it was previously, and those projects sometimes take years to come online. So the undersupply of energy globally is not going to be fixed by one or two geopolitical movements. Now, the quickest thing is U.S. shale. That can get online in the matter of weeks. And so that would be something to keep an eye on, is that if shale production increases rapidly, and already has begun to increase, but if it really ratchets it up, gets close to what it was in 2014, 2015, then that would probably provide some nice relief to energy prices. But overall, probably the path of energy prices is to stay high. Yeah, I think once you get above $100 a barrel, demand destruction will come into play. That is, you'll see businesses and consumers in particular start to change their behavior. And as I say, for commodity prices, the cure for high prices is high prices. So I think there is somewhat of a ceiling absent any sort of massive geopolitical issues. There probably is a point when there's demand destruction, but overall, you'll probably see oil prices stay higher than they have been over the past several years.
Okay, thank you. And Nededavis reducing U.S. equity outlook from bullish to neutral last month. And will you continue to maintain that view, or will you change it soon? What is the reason?
Yeah. So when we make those kind of changes, we do so with at least a few months time horizon. So our expectation would be not to make a change right away. Now, that being said, if indicators change, we have thousands of data series and indicators that we look at every day, every week, every month. If those change, we will change with them. So we're not going to be beholden to something that we may have said a month ago. But our expectation is that we'll be in this position for a while. And the reasons for them were not short term. It has to do with the Federal Reserve preparing the markets for raising interest rates. It has to do with earnings growth slowing very rapidly. For S&P 500 earnings in 2021 are probably going to be around 65% growth.
Right.
It's likely going to be less than 10% this year, and it could be close to zero. So when those cycles move, from easing to tightening, from high earnings growth to low earnings growth, the stock market does tend to notice, and returns tend to be lower.
And last December, you said corrections of more than 10% in the first half. Is this that corrections? And your prediction was right. And although investors might have been disappointed, do you think the stock market correction is over, or should investors prepare for the bigger drop?
It's too soon to say that the correction is over. Once a correction gets started, probably the first place you want to look for reasons that it's over is through the price action of stocks themselves, or what some people call technical analysis. And what you want to see are positive divergences. That is, let's say the S&P 500 index or the Dow Jones Industrial Average makes a new low, but fewer stocks make a new low, or not as many sectors make new lows. That's a sign that the selling pressure is starting to abate, and you can start to look for a bottom. That's often a process. It unfolds over several weeks, or if not months. So we're still in the early phases of that. So that's what we're watching to say that the correction is over. We just haven't seen a whole lot of signs of that up to this point.
Is there any sector valuation have started to look some more attractive again? How about the big tech?
Yeah, it's gotten better. but it's still most of those big tech names, or we call fan mag stocks, because some of those stocks actually aren't in the technology sector. They may be in consumer discretionary, communication services, but we all think of them as tech stocks. But some of those valuations have improved through price corrections lately, or through some decent earnings growth. So it's not as big of a concern as, say, in the fall of 2020, when those stocks were owned by almost everybody, because during the pandemic, those companies were perceived to be very safe. But they're still pretty pretty elevated. So if you're investing just on valuations, those are probably not the first places to look.
The 10-year U.S. Treasury yield rose to 2%. And do you think it will go up even more in short term? If the Fed hike rate in March, is it likely to rise further?
I think you could see a little bit more upward pressure on the 10-year Treasury yield. Our models suggest fair value is approaching about 2.25%. So there's a little bit more upside risk to bond yields. But if interest rates were to rise much more, particularly if they were to rise quickly, I think the market reaction would be more from what we call risk on, where risk assets like stocks do well, commodities do well, to risk off. That is, those kind of asset classes do worse. In that case, I think you could see bond yields actually come back down. So the beginning phases of a correction usually have rising interest rates, and then the latter part tends to be more about falling interest rates as investors seek safety. In addition to that, the yield curve, or the spread between short-term interest rates and long-term interest rates, tends to peak early on in a Fed tightening cycle. So the market looks forward and says, okay, the Fed's tightening interest rates, the economy is going to slow, so long-term interest rates should come back down. So that would mean that possibly we could see 10-year yields peak out in the next several weeks to couple months.
What do you expect FOMC next month? There are many hawkish observations in the market. There are claims that we need emergency hike in this month, and 50 basis point hike in March.
Yeah, I think people looking for those kind of moves are probably looking at traditional measures of where interest rates should be versus where inflation is right now, and that's their justification, and rightfully so. But the Federal Reserve is still actually buying bonds already. They're still doing quantitative easing. So for them to do quantitative easing and then immediately raise 50 basis points, is a little bit of a sharp turn. If they were going to do that, I think they would have canceled the last tranche of bond buying, but they didn't. If they would have done that, they would have done that a couple of weeks ago. They didn't do that. So I think instead you're probably looking at 25 basis point increase in March, the end of quantitative easing.
The February CPI will gonna announce a week before the March FOMC. And is it important to you?
If there's a major surprise, I think that could adjust the Fed's thinking. But I think that they prepared the markets for a rate hike in March. So I think have to be a substantial surprise, not just from the CPI, but other data points like the February employment report that would cause them to change what they're doing. But also because of the year-to-year change, looking back over the last 2 years from when prices collapsed during the pandemic in 2020, then rose sharply in 2021, it's very unlikely you're going to see the year-to-year change in consumer prices decline sharply at the next month's reading. So it's the Fed probably has high confidence that inflation is going to remain pretty high next month.
And in the last interviews, you said that the Fed is more likely to raise less than 3 times. And do you still see that way? Or Jamie Dimon said he expects a 6 or 7 hike this year, and market also.
Yeah, I think that's probably the biggest change since we spoke last, and that's part of the reason why we reduced our equity outlook from bullish to neutral. Is that the Fed has signaled that they are going to raise rates several times this year. Whether it's 6 or 7 or 4 to 5, it's going to be more. One thing they might do is focus more on quantitative tightening and have fewer interest rate hikes, because the Federal Reserve doesn't want to invert the yield curve. That is, short-term interest rates higher than long-term interest rates. So if they raise short-term interest rates too quickly, they could do that. So instead, they could do some quantitative tightening instead. And so that may mean not as many hikes as the market is looking for right now, but still tightening, which would be the Fed's objective.
What is your view on the balance sheet run-up? When and how do you expect the balance sheet reduction to begin? And will it affect the market a lot? Maybe a long-term rate spiking, something like that?
Yeah, so I think the Fed will start that in June or in the second half of the year. So again, they're still buying bonds. So to immediately turn around and start selling them, would be a curious policy decision by the Fed. But the largest holdings by the Feds are Treasury bonds, but they also own almost $3 trillion of mortgage-backed securities, or those related to the housing market, real estate market, and that could be a place the Fed could look to reduce its balance sheet first, particularly because in many parts of the United States, the housing market is extremely strong. And so it doesn't need the support of the Fed as much. So that could be their initial focus of quantitative tightening is on the mortgage-backed part of the market. And that way you don't have the dislocation of as much from spiking Treasury yields, which every other interest rate is benchmarked to.
The Fed decided to sell the bonds, such as MBS, and is that decision will shock the market? Not just the run-up, it's just selling.
Yeah. Okay. Yeah. Good point. So bonds mature all the time, and what the initial plan would be for the Fed just to not repurchase as many as maturing, and so their balance sheet would get smaller. If they decide to out and out sell, I think that would really depend again on what they're trying to sell. So you'd have to look at maybe their mortgage-backed securities. If there aren't as many maturing as they'd like, then they might actually sell, versus there are a lot of Treasury securities on the balance sheet that are going to mature this year. So I think the selling probably would focus more on the mortgage-backed side. But if not, I think that would be a change in character, and the market would need to take notice and be viewed as a very hawkish move by the Fed.
And U.S. CPI is skyrocketed in 7.5% in January. When do you think the high price in the States will peak out?
Most likely in the second quarter, so sometime April, May, June, and that's just looking at the year-to-year changes from what happened in 2020 to 2021. Once we get past those months, when in 2020, the U.S. economy is largely just shut down, you're going to see the base effects start to roll over, and the CPI start to come down. So just the math of the situation leads us to believe it'll be the second quarter of this year.
Please give your opinion on the fourth quarter earnings season. Have you found some kind of hope, or are you a red flag bigger? So it's a kind of a bad sign, something like that. And do you think corporate EPS will still grow 8% this year?
Yeah, so there's been some signs to think that 8% may be a little bit too high. It could be closer to 5% or less. In particular, if you look at the companies that have reported, and about 2/3 of S&P 500 companies have reported, the beat rate or percentage of companies that have beaten expectations is around 80%. Which is good. Now, in the last year and a half, it's been closer to 85%. So it hasn't been quite as strong. But probably more importantly, companies have not raised guidance for 2022. Right. Last year, companies were beating expectations, and then they'd say, oh, well, the next quarter is going to be even better. well, in the next earnings season, well, next quarter is going to be better. That's not happening now, and that's what normally happens. So we're back to what typically happens during the course of the year, which is analysts and management teams are a little too optimistic and get more realistic as we go. And so consensus is around 10%. That should come down, several percentage points again, get maybe closer to 5%. Is what we end up with by the end of the year.
I'm asking about China. The Bank of China cut interest rate. What is the outlook for the Chinese entire economy and the market? Is that the time to buy the dip in China?
That would not be our recommendation at this time. Globally, we're more neutral on China and emerging markets than overweight. The challenge for China right now is they're a different phase of the pandemic. They're still in more lockdowns than most of the rest of the world. So they have incentive to ease monetary policy, whereas many other central banks, as economies come out of the pandemic, are looking to tighten. So that's not exactly great for economic growth. And furthermore, there are a lot of companies that are reconfiguring their supply chains to diversify away from China. Maybe they felt like they had too much into China for their supply chains. So that's part of the supply chain issue right now. But that's also probably a net a negative for Chinese economic growth over the next few years.
If you have $1 million in cash right now, where would you like to invest in?
Europe, Ukraine crisis notwithstanding, looks fairly attractive in that valuations are cheaper than most of the rest of the world. Those indices actually have a higher weight in some sectors that look attractive to us, like energy and materials. And so that would be another reason to be interested there. But we do like the U.S. Overall. Now, I am the U.S. strategist, so I probably have a little bit of bias, to the U.S. But within the U.S., we also, again, we like energy materials. We also like consumer staples as an interesting sector. Maybe as the market goes through a correction phase, consumer staples companies tend to be a little bit more defensive. And then also dividend paying stocks had been neglected for such a long time. They're deeply oversold if you look at their performance, typically over, say, a 3-year period. That could be an interesting part of the market to focus on as well. And then outside of stocks, I would say commodities are an interesting asset class to look at as well, because again, some of these supply chain issues are going to be here for a while.
Are you talking about the dividend stock? Is the economic cycle we are in the late economic cycle right now?
Yeah. So the worst time to be in dividend stocks is actually at the early phases of a bull market, because at that point it's all about risk on or low quality stocks. That's exactly what dividend stocks are not. Right. So we're entering a phase in the stock market cycle and economic cycle that's more favorable for them. The first interest rate hike or two tends to be a little bit negative for dividend stocks, because as interest rates start to rise, they're competing with the dividend yield. So if you're an investor and you think, I want yield, well, maybe I can get it from the bond market, not the stock market. But as the Federal Reserve gets deeper into the tightening cycle, as I mentioned earlier, the yield curve tends to flatten. That interest rate competition isn't quite as great, and usually economic growth slows a little bit, so that tends to be positive for dividend stocks too. So it will be in a phase when it's more positive for dividend stocks. And then also, as I alluded to earlier, dividend stocks are very oversold still. So there's room for them to play catch up versus what they've missed over the last several years.
Thank you. That's all for today. It's a really great pleasure to have you in this interview. And I got a lot of great answer from you. Thank you very much.
Thank you. Great to be here. Appreciate it.
Yeah. See you on April.
Yeah.
Bye.
You too.